Hi guys, this is Tim Melvin of the Deep Value newsletter and the Banking on Profit service, coming to you from down here on another gorgeous day in Central Florida. I suppose it's eventually going to cool down, but for now we're staying in that mid-80s range. The alligators are still hanging around and haven't gone into their kind of winter nap that they like to take. So, but I am packing up as soon as I'm done this video, heading up to Chicago tonight. My son-in-law got tickets for the Chicago Cubs game. I may have mentioned that last week. Pretty excited about that. Of course, the Cubs are in an 0-2 hole, so that's not good. They've got some digging to do in order to get out of that. But while I will be rooting for the Cubs to come back and win this series, should the Mets defeat the Cubbies and move on to the World Series, to all my Mets fans, I will be rooting for the New York Metropolitans. I'm not a big fan of either one of the American League teams that are left. Got to give an edge to Kansas City. And after what they did to Baltimore last year, I just can't be a fan. Now, of course, right after the series, I am hopeful that the Mets will engage in a blockbuster trade and send their entire pitching staff to Baltimore in exchange for our pitching staff, Matt Wieters, and a bushel of steamed crab. Seems like a pretty fair deal to me. Anyway, we've been spending a lot of time this week studying the results from the Banking on Profits monthly newsletter service. And as you know, in that service, we do just kind of a broad overview of the industry, give you an update on our thoughts on the economy, the markets, and bank stocks in particular. Now, we also keep very close track of 13D filings, insider buying in the sector. We provide some special screens for stocks, with high yields or high return on equities or whatever struck my fancy that month. But as I've been looking through the returns, particularly from the 13D filings, the activist situations that we cover each month, the returns for the first year of the portfolio have been not portfolio, but service of the 13D filings have been spectacular. Each and every month there's been, a handful of them, 4 to 6 on average, and the aggregate returns each month have been between, 20, one was 33%. I think the lowest that we saw so far was about 16.5% from the time we picked them up through today. Just clobbering the market, which of course is flirting between positive and negative on a regular basis, and over the last year is only up about 4%. So this works. The small community bank trade, the small regional bank trade is working. It's working extraordinarily well. When activists get involved, you gain a huge advantage. As I've said often, that if you're buying a stock at book value or less, and community banking has an activist involved, it's like being dealt aces every time you sit down at every hand of poker. So the service absolutely works. It's a huge value add. We're going to make some upgrades to it. We're adding features. We're going to be doing more interviews with hedge fund managers, mutual fund managers, bank CEOs, and that type of thing, and providing them to you as a part of the service. Now, we raised the price on the Banking on Profits regular service last month. We're going to raise the price on Banking on Profits service, monthly service this month to $199. It's very time consuming to put this thing together every month. We want to add new features. We want to do some sound system upgrades. By the way, you'll notice this. I'm doing this without the headsets this week. The sound quality has been poor, and what I've found playing around with this at home so far, the best sound quality for now, we're going to do an overview of all of this thing, but I'm going to record this on very high volume, and then you need to just bring the volume down on your system, and it sounds almost normal. So hopefully we'll get this figured out. The videos will be a little higher quality going forward. By the way, for subscribers to the Banking on Profits monthly service, we did just send you a link to the interview that I did with Rhino Capital's John Schneider. They run a small cap financial services fund that focuses on the community bank stocks. It is a fantastic 30-minute interview. If you have not done so, go back and listen to that. He throws out some very specific ideas that I really think can make you some money going forward. So if you haven't listened to it, take the time. It's a great discussion about community bank stocks, where we are and where we might be going. Now, I just want to read you a little something here that I came across in the files today. Now, by the way, going back, now, of course, if you're a subscriber to the regular Banking on Profits service, you continue to get the Banking on Profits monthly service free. That's not going to change. We are taking the price to $199, but we also, I like to be fair about this. If you're on the fence, you've got till November 15th to lock in the $99 price for life. Then we're going to take it up to $199. First off, it's worth it. It's making people money. And secondly, we need the cash flow to justify the effort and the extra money we're going to have to spend to make the product better. So I hope you join it. join us with this. I really believe it'll make you a lot of money going forward. 1 or 2 takeovers pays for this subscription, pretty much for the next 2 or 3 decades. So $99 for the full year. We'll lock you in at that price for life, but you've only got a couple weeks to do it. Now, just ran across some stuff. I want to read you some stuff and see what you think about it. Here's some comments that I wrote. It says, you might be able to sell me the fact that this market is fairly priced, provided I've been drinking heavily, but undervalued, I can't see it. The bond market and the dollar are telling you that it's just not that good out there in the economy right now. And we've rallied quite a bit since August without a real pause, and anybody who is not cautious now pretty much deserves what they get. A few months later, I wrote, even if I'm dead wrong here, I think the risk of being fully committed to stocks carries too many risks for the idea that a margin of safety to exist. I'm willing to miss this run-up to protect capital. There appears to be very little common sense being used on Wall Street these days when it comes to the overall economic and financial matters, as well as a total lack of fear. Bottoms are accompanied by fear and loathing, not cheerleading and bottom predictions. The bullish arguments are laughable. Now, I could have written that any time in the past year and probably have written something very, very similar. But, guys, the first paragraph was from December 5th, 2006. And the final paragraph was right before everything really went south on April 1st, 2008. So the more things change, the more they stay the same. When you're underperforming, as we are in the deep value portfolio, sometimes you start to feel a little bit stupid. We're sitting here with 50% cash in the portfolio, scratching our head. We are lagging the market. And just as kind of a sanity check, I went back through the archives looking, and I've expressed similar sentiments to this clearly in 2006 and 2007. And it sounds a lot like some of the things that I wrote back in 1999 and 2000, where it's similar concerns about the elevated levels of the market. I don't know when the markets will turn. I know there's a huge disconnect between real economic activity and stock market levels. I know that a lot of the earnings growth has been financially engineered using stock buybacks over the last 5 to 6 years, and I do not believe that's sustainable. Our chance will come, and I'll be ready. Let me catch you another couple paragraphs here. This is from March 14th, 2009. You can buy stocks right now for less than the value of the company's liquid assets. You can literally build a portfolio of 40 to 50 of these that have good credit scores, viable businesses, and excellent recovery prospects. That's enough to make me salivate at the possibilities of gains over the next several years. And of course, that's exactly how that worked out. We were scooping up all kinds of very cheap stocks, REITs at fractions of book value. Here's another paragraph written the same day. Now, remember, the market actually bottomed March 9th, so I was a little bit late. I was 5 days late with this. We had just come back from a trip with my older kids to Walt Disney World in Florida. It was before we moved down here, obviously. And as I walked around, I mean, everybody's in panic and fear, but Disney looked good. The rides were running. They were selling Mickey Mouse ears, and there was lots of people there. So I came back home and I sat down, and we got comparable land values from Orange County, Florida, and we evaluated the property and the cash flows of each division. And I wrote this: Walt Disney trades for about 2/3 of my appraisal value. That's provided we give no value at all to the film library, character rights, and price the parks as raw land and put a 5 multiple on after-tax earnings. Dell trades for less than 2 times cash. HTH, Hilltops Holdings, which has worked out extraordinarily well, is a pile of cash in the hands of a proven investor in distressed banks and other financials. As a bonus, the company landed a backdoor bank charter recently and will be able to bid on distressed assets and institutions. Southwest Airlines is stupid cheap. Stock was around $5 a share, as I recall, trading below tangible book value. Oil services companies like Rowan and Patterson trade below net asset value at these levels. I love the idea of buying Forest City senior debentures at a 30% yield to maturity and what looks to be more than adequate asset coverage. And we bought those things at between $4 and $5. They were yielding 30%. They never defaulted, and they eventually parred out. And I believe it was $25 a share. So we made an absolute killing on the Forest City debentures in that overall panic. It will happen again. I don't know when, but it will, and we'll be ready. In the meantime, we're just going to sit here. We're going to feel stupid, hold our cash, probably underperform a little bit, pick at the spots where we can find them. We've got a couple real estate trusts that we think are attractive. We're probably going to add in, the next decent little down move. So, It feels a little silly being a deep value investor right now at this point in time, as markets definitely favoring the growth side of things. But I've been stupid before, and I gained the IQ points back very, very quickly as soon as the markets begin to correct. In the meantime, we've got all these lovely communities, things, bank stocks to buy. There's lots going on there as we go into earnings season. We saw the first earnings report today. Profits were up just a little bit, about 400% year over year for this particular little bank. So we're excited about it. We've got stuff to do in the community bank space, and eventually the deep value side of this will come back to us. Now, got to go finishing, get ready to fly to Chicago. Going to spend some time with my daughter and my son-in-law while I'm up there. Be coming back Friday, but late in the afternoon. So probably going to reverse things a little bit. I'll send the reading list out to subscribers on Friday night, and the actual weekly commentaries will go out late morning, early afternoon, Saturday. So I will talk to you guys next week. Have a fantastic week, and go Cubs.